What's up, YouTube? We are back with another video. We are back with another video, YouTube. back. A new week is coming up in the markets. And y'all know, a new week coming up. I gotta, you know what I'm saying, get ready for the week. Prepare myself for the week. New week coming up, man. So it's just about, you know what I'm saying, being prepared for that new weekend, making things happen. But today in this video, I'm going to be giving away my strategy. Alright, so today I'm going to be giving away my strategy, what I look for, confluences I look for, what makes me enter, what makes me exit, and everything in between. So boom. As y'all know, I find my strategies, my setups on the hourly time frame. So it's like you can call me I wouldn't call myself a scalper. A scalper is somebody who does it in like 5 minutes. I feel like the scalpers are people who trade and be in and out of trades in like 5 to 10 minutes. That's a scalper in my opinion. Even though I do be in trades for like 5 to 10 minutes, the waiting time for me to find my trade, it don't be 5 to 10 minutes because I don't trade on the 5 minutes. So I don't even look on 5 minutes for my strategy because it just works best for me. It might be different from you. It might be different for a lot of different people. You know what I'm saying? But for me, I find my setup on hourly. And as y'all can see, I trade gaps. Some people call them what they call them, fair value gaps. I just call it a gap because it's just a gap. So first of all, before even getting into it, you have to understand what a gap is and what makes a gap or a fair value gap. So a gap is a 3 candlestick pattern that leaves a space in between each, the first and the third candle. That's what a gap is. So basically, as y'all can see, I have a whole lot of gaps on my chart. My chart is just filled with gaps. A 3 candlestick pattern. You see, this is candlestick 1. This would be considered candlestick 1. This is 2, and this is 3. 1 and 3 do not share a price. Since candlestick 1 and candlestick 3 don't share a price, it creates a gap in between candle 1 and candle 3. So the space in between the first and the third candle don't touch each other. It's a gap. So basically like this. You have 1, 2, 3. 1, 2, 3. The gap is made. The space in between it is the gap. Basically, how you enter. Well, what was I about to say before that? Basically, let's just talk about how you enter off the gap. I come to the chart and just start from square one. I come to the chart, look at the daily, 4-hour, hourly. I look on the 4-hour and the hourly in some cases and find where I would like price to come and get into. So boom, I see a gap made here. We're gonna just do the most latest gap that ever happened. So you got boom, 1, 2, and 3. This right here, this space in between is considered the gap. So now we have a gap made. 1, 2, 3. Y'all can see the gap is now made. There are a couple places where you can enter off the gap because gaps have scenes. It's like a movie. It has different parts of the gap that makes it do what it's supposed to do. I enter off the gap when price comes back to the gap. So the first time price comes back to the gap, that's when I enter into my trade and I take it either up or either down, depending on what type of gap was made. This is a positive gap. Not a positive, but a green gap or a upwards facing gap. So basically, next time when price continues, it's gonna go up, go up, go up, come back down, and when it comes back down to that gap, that's when I take the trade. I take it up in a buy-in position because this was an upwards facing gap. This happened in between upwards facing and an upward facing momentum, downward facing. Okay, here's a downward facing one. Boom, this is a downward facing gap. Price was moving down off the gap. So when price was moved down, it's 1, 2, 3, the gap was made. Continued down. First time it came back to the gap, what did it do? It retraced. Boom. Price came back to the gap. When it came back to the gap, what did it do? Boom. This is a move down. It might look like a small move, but this move probably would have made some people thousands, hundreds of thousands of dollars. So it might look like a small move, but it makes money. Best believe. Basically, that's when I enter in. I enter when the price comes back to the gap. Take it for a sell position. Sell it, and when I look for my targets, I have a risk and reward calculator that tells me how many contracts I should enter off of and things of that nature. But most times I go based off of the 5-minute and look for my targets. When I'm looking for my targets, I go off the 5-minute chart. I look on the hourly. Well, I find my trade on the hourly, but usually some of my confluence be, say a gap is made on 2 different time frames. Say I got a gap on an hourly and a 4-hour time frame that low-key match up. When they match up, that just gives me more confluence that, okay, this gap is going to work, because it's not going to work every time. No strategy is 100%. So it's not going to work every time. So it might work this time, but it might not work this time. But it's all about your risk, for one, and your confluences. If I have a lot of gaps on multiple different time frames matching up on more than one time frame, it gives me a lot of confidence in that gap for it. So when it does come back down to that gap, that's going to continue on. For example, that's why I show model this gap. This is a great example. This is on a daily chart. A gap was made here, but if you go to the weekly, this is a weekly gap that's covering it, which is, I think it's this one. So boom, gap was made at the same exact point on the weekly and this one. So that lets me know next time price goes up and comes back down to that gap, it's going to shoot back up, because I have multiple time frames matching up that gap, and it's giving me more confluence and belief that next time it comes to this gap. And as you see, it even created a resistance. Well, not a resistance, but a support. So it came here, boom, shot up. Came here again, shot up. Came here a third time. Is that a third? Yeah, that's a third touch. And shot up once again. So this would have been a great support level as well, which is another strategy that I can teach. So boom, as y'all can see, price made a gap on the hourly and the weekly. Not on hourly, but the daily and the weekly. The higher the time frame, the stronger whatever you looking for is. On the daily and the weekly, price came back down to that gap, which is a gap on the daily and the weekly, and it shot up 1 time, 2 times, and 3 times. So now that also gives you a level of support. So next time it comes down here, you can think and have a confluence in your mind of thinking, okay, this was a strong support level. Buyers wasn't letting it come no lower than this, and it'll more than likely could shoot up again, create my confluences. But for the most part, that's my strategy. It's called a fair value gap, some people call it. And that's the only strategy I mostly use. I use support and resistance sometimes, and I can make a video on that as well, because I just last week, not even last week, well this previous week, I took a it might have been the week before last. I took a support and resistance. It was a resistance, I think. And it was such a great trade. That's my strategy. If I explained it bad, let me know and I'll make another video on it. I feel like I low-key explained it bad, but Thank y'all for watching this video.